Wanted to ask you about the dissents. We had two of them today, one from Kaplan, the other from Neil Kashkari. So perhaps one on the hawkish side, one on the dovish side. But we've come out of a series of unanimous moves by the Fed. What does that dissension tell you?
Well, it tells you that there's some disagreement, obviously, that they're not absolutely clear on where they're going. In a sense, there has been a shift. And the key thing is Jay Powell's Jackson Hole speech, which is a whole new strategy for the Federal Reserve, which I very much welcome. It's actually something I've advocated, this so-called average inflation targeting. And I think they're trying to sort out exactly what that means. And maybe this is an indication that they haven't quite sorted it out yet.
What does average inflation targeting mean to you?
So here's the key. One of the big problems you have when you're in a situation where interest rates are so low, and you have a need for much more expansionary policy, is that the Federal Reserve is hamstrung because they've already gotten the federal funds rate down to zero, which they did in March, and you can't do anything more. You're basically at what we call the effective lower bound. You can't go much below zero. So the question is, how do you make sure that your people understand you want to be very stimulative? And one way to do it is to indicate that when you've had inflation lower than your target for a period of time, which is, of course, what has happened, lower than the 2% target, then in fact you want to indicate that for a short period of time, you actually want to shoot for a little bit above that, because it's not just that you want inflation to be 2%, you want it to be average to be 2%. And that's really key. And I think it's a very sensible strategy. What it means is when you have things that have been bad in the past, you now care about them.
Sure.
The old way of doing things was bygones versus bygones are bygones. Whatever's happened in the past, you don't worry. Now we're saying that because things have been weak in the past, we actually have to be even more expansionary in the future and keep interest rates low for longer periods.
That's fine. And maybe we can show this chart that Steve Leisman has prepared from the documents that were just released. But, Rick, if that's all the case and the Fed wants to overshoot a little bit and all that, why doesn't it think it actually can? I mean, they don't believe themselves to think that they're going to get a higher than 2% inflation for years.
This is the big problem. And that there are several issues. One is that we found that we used to think, and the theory tells us that if you just create expectations that you're going to do more, it'll help. But in fact, it's actually very interesting when you look at the case of Japan, that they've actually changed their monetary policy in major ways, starting in 2012 with Abenomics, and it really didn't affect expectations very much. That's a challenge for the Fed. The issue, I think, here is that you got to do what you got to do. You do the best you can. But if you notice, many Fed officials have kept on talking about the fact that the federal government needs to do something. That in a situation like this, that the monetary policy is not going to be as effective. We're at this lower bound, that we had big negative shocks. This is when you need fiscal policy to kick in. And of course, we know that there's been a lot of fighting around Congress. They just can't get a stimulus bill passed. So the bottom line is central banks need to do what they need to do. That's still very important. But it may not be enough, and this is clearly a situation like that.
So where does that leave us then if you're basically saying, the Fed really needs fiscal policy to take the baton here, and it may or may not? Do you believe that their quantitative easing, especially if they do more of it, is causing distortions in the economy, or that it's concentrated in asset prices, that it's not making its way into the real economy? Or do you just think it all needs to take some more time to play out?
No, I think it does work, but the problem is, for example, it's very effective in affecting financial markets. The stock market is clearly much stronger than it otherwise would be because of Fed actions. In fact, stock market's near the highs that it had before the coronavirus. That's actually important. The problem is that doesn't mean it has enough effect on the real economy. And so this is the difficulty that central banks face. They're not all powerful. People think that central banks can do everything. They can't. They can affect asset prices, but then the question is, the effect on asset prices, is it enough to actually get the economy moving the way you want it to get moving? We saw this happen during the financial crisis. The Fed did a lot of things that were very, very positive, but in fact, we had a very, very slow recovery. What the Fed can do that's really important is it can prevent a financial panic and a financial crisis.
Yeah.
And that's exactly what they did in March. That was hugely important. Great that they did it. Great that they did it as quickly as they did. In fact, they had a sort of war games, which were showing them how to do it from the last crisis. But once you do that, then basically your power is limited. And you have to recognize that and do what's right, but recognize that you may need more. You may need help in other parts of government policy.